Welcome back. You're watching Commodity Champions, and the commodity prices have come off its 2023 highs, posting a negative February as the US dollar index rebounds to a 7-week highs. The markets are factoring in a 50 basis point rate hike in the next meeting. Also, the uneven and erratic China recovery, the commodity powerhouse, seems to be weighing on commodity prices. That's one. And the other big one that the street is watching is the Black Sea Grain Initiative brokered by the United Nations and Turkey in last July, allowing grains to be exported from 3 Ukrainian ports. The agreement was extended in November and will expire now on 18th of March unless there is an extension that is agreed upon. To take this discussion ahead, I am now joined by Carlos Mera. He's head of commodity research at Rabobank. Carlos, hi, thank you so much for joining us. I want to start with the Ukraine concerns first. And while the last year has been positive, we've seen those numbers, but that deal expires on 18th of March. We do hear that there are conversations going on right now. How are you reading, one, on the export numbers itself, the kind of production that Ukraine is looking at, and the availability overall in the international markets?
Yes, you said, the deal is going to expire in about 3 weeks. So there's a lot of attention being focused on that deal and a potential extension. Last time it was extended, it was very close to that timeline. So we also expect the same to happen at this time. We expect any announcement to be made very, very close to the deadline. However, the grain deal is very good. It's very good for Ukrainian farmers. It's very good for Ukrainian agriculture generally. But the low-hanging fruit of that deal, which it was exporting existing stocks in and around Odessa and the crops that are accessible from that area, that has already sailed. So going forward, we will expect to see a little bit lower exports, even if the deal is extended. And of course, there have been delays in the inspections as well. And looking a little bit further ahead, we're looking at a decline in Ukrainian agriculture. So for example, when we look at winter wheat plantings, they are 30% lower year on year. Of course, the plantings before that were exported last season, they were planted before the war. So from that level, we got at least a 30% decline. So in any case, the deal is great to have it there for as long as possible, but we should expect to see lower exports going forward.
Carlos, would you say that the markets have factored that in as well, and as of now there is sufficient supplies? Because when you look at the global wheat prices, we're trading at a 17-month lows. We've seen corn and edible oil prices come off from its highs as well.
Yeah, well, a couple of reasons there. You mentioned the strength of the US dollar. That's clearly in the market. I think most of the market already expect that deal to be extended. There's a lot of international pressure for Russia to maintain and respect the grain corridor out of Ukraine. And also, we might be looking at better weather ahead. I mean, we're coming from 3 consecutive La Niñas events globally. That's very detrimental for grains and oilseed crops on a net basis globally. And that this La Niña event is weakening and it's expected to go away, maybe within the month or within the next 2 months. But with La Niña away, there's an opportunity for crops to recover and potentially will be moving to global surpluses of a number of crops. We expect, for example, in Brazil, to see a much bigger soybean crop, a bigger corn crop, bigger sugar cane, and bigger coffee crop in the coming season.
All right. Since you mentioned coffee and sugar and cocoa, these are a few of commodities which actually have continued to trade on a higher side. For the month of Feb in the positive as well, how are you looking at sugar, where a recent international sugar organization report suggests that the surplus may not be as much as the agency was earlier forecasting? And we've seen coffee and cocoa prices continue to be on a firm rooting as well.
Yeah, well, different fundamentals for all of them to a great extent. In terms of sugar, of course, we have India maybe producing a little bit less than expected. There was a recent downgrade to the expected volumes of the current crop by ISMA. that's already in the market and is affecting the front end of the curve, which is trading at a very strong premium. Now, when we look further ahead, as I said, that expected increase in Brazilian output will come in, and that will lower prices ahead, and that's already in the forward curve. I think we might see lower prices in the future, but for the time being, we have quite a bit of a deficit in the front. And when it comes to coffee,
well, yes, I was going to ask you about coffee, where we have seen support, and cocoa as well, because I remember, Carlos, most reports suggesting that Europe, which is the largest consumer of cocoa, isn't doing so great. So we might be looking at lower consumption, but that also has not played, and we've seen coffee and cocoa both trade firm.
Yeah, different fundamentals there. On the coffee side, we still see very strong differentials out of a number of countries. Coffee has had a rally already, right? For the last month or so, we saw prices strengthening quite a lot, from $145 per pound to currently $180, almost $190 at the front. So with that background, that physical market is very bullish. But also, I have to say, I think most of the rally is there, and from this place, we might even see a little bit of a reversal. The peak of the rally was during Carnival in Brazil, so there wasn't enough coffee to be sold against the rally. Now, this week, Brazil is back to work, so we might see a little bit more sales. That might quiet the market a little bit. But all in all, I think coffee is relatively well priced. When it comes to cocoa, it's a little bit of an enigma. On the one hand side, demand, we're not expected to be doing that great. Maybe demand expectations were very low in Q4, especially because Europe is the largest producer. EU consumer confidence was rock bottom in November, December, because of the energy crisis, the war, etc. Now there might be a little bit of a recovery, but also we hear that the situation in West Africa is not that great. The supply side is not looking great out of West Africa.
Clearly that. So would you, when you look at the overall agri as a space, Carlos, when you look at the month of March as well, given the kind of fundamentals that you just spelled out, if you were to pick a couple of strong trades, long or short, which one would those be?
Well, when it comes, for example, to wheat, I think we might see short-term weakness because, as I said, extension of the Ukraine grain deal, plus very strong Russian exports. So we may see that weakness in the next couple of weeks, 3-4 weeks. But then going forward, like 6 months forward, looking at Russian next crop, we're going to see a big drop. So we believe wheat might be well supported. And I think the wheat-corn ratio will increase from that level. So I will be bullish that wheat-corn spread.
Okay. I also want to talk about China because that is a powerhouse of commodities, and the January as a month saw a lot of pent-up demand coming into China. The estimates were raised after the zero COVID policy was eased off. But Feb clearly has weighed on many of these commodities. So money managers, hedge funds, which had started picking up various commodities, including soft commodities also, seem to be taking profit out right now. How are you looking at Chinese consumption going forward?
Well, I think clearly China has been reopening from numerous stories about demand of many goods has been doing very good. So certainly in terms of veg oil, I will probably be a little bit optimistic because of the reopening. China is not a huge importer of soft commodities, but of course it's a huge importer of soybeans. However, the story there, and corn to a lower extent, however, the story there is that China has been scaling up the production of hogs. So the production of hogs now is much more industrialized in China. Therefore, the feed demands is less. They don't, they have very good genetics, they have very good treatment. So we don't expect an explosive import program of soybeans nor corn.
All right. One final question, and we'll wind down this conversation, Carlos. This one is on what is your sense? I mean, we spoke about the dollar index, and that's holding firm at around 104 or 105. And then the markets also are factoring in a 50 basis point rate hike. If that was to happen, what percentage move would you then expect in case of commodities, or do you think that has been factored in already?
I think that has probably been factored already, to be honest. We do expect, as Rabobank, we do expect to see dollar strength throughout the year. So that might create a little bit of weakness, but at the moment, the next hikes, I think they are already priced in.
And how much of dollar strength then are you expecting? Are you looking at levels beyond 110 yet again?
Probably not that level, but you have to ask all macroeconomists. but certainly a little bit stronger than now.
Okay, so the strength in US dollar is something that we'll have to live with, and that would perhaps keep many of these commodity prices in check. Carlos, as always, thank you so much for joining us and talking with us with the whole host of all those commodities. But with that, it's a wrap on this edition of Commodity Champions. Thank you for watching.